Welcome to the GCV Weekly Briefing, where we break down the key financial and economic developments shaping the landscape for investors, businesses, and policymakers. I'm Matthew Robineau, and this week we're taking a look at frozen income tax thresholds, falling house prices that might not stay down for too long, record-breaking US markets, and finally, some cautious optimism in UK manufacturing. There's a lot to get through, so let's get started. We'll begin with income tax. Labour's position on freezing income tax thresholds just became less clear. Earlier in the year, the party promised not to extend the freeze beyond 2028, but that promise is now in doubt. The Chancellor refused to reconfirm it in Parliament this week, instead pointing to the growing £30 billion black hole in public finances. The silence is significant. The current threshold freeze, originally introduced in 2021, means inflation-linked pay rises push more people into higher tax bands, even if they don't actually earn more in real terms. It's been labelled the stealth tax, and the numbers certainly back that up. To give it some perspective, over 7 million people are now in the 40% tax band. That's up from 4.4 million just a few years ago. And it's not just working age earners that are being dragged in. Nearly 9 million pensioners are expected to pay income tax in the 2025 to 26 tax year, compared to fewer than 7 just a few years ago. If you earn just above £50,270, every extra pound is now taxed at 40%, not the basic rate of 20%. That's a sharp jump, especially for middle earners. So, with limited fiscal headroom and pressure to avoid headline tax increases, Labour may quietly keep the threshold freeze going. That would mean more people paying more tax without actually changing the rates. Next up, UK housing. Nationwide reported that house prices fell by 0.8% in June. That's the biggest monthly price drop since January last year. Annual growth also slowed, down to 2.1% from 3.5% in May. That puts the average home at just over £271,000. Now, there's a few reasons for this dip. First, stamp duty thresholds reverted back to pre-2022 levels in April. That's hit first-time buyers particularly hard, and at the same time, more properties are hitting the market. Some agents are calling it a surge in listings. But there are signs of a potential rebound. Mortgage approvals actually rose in May, the first monthly increase this year, and new loan rates are at their lowest since April 2023. So while monthly prices dipped last month, market activity is actually picking up again, just quietly. It's also a mixed picture regionally. Northern Ireland leads with 10% annual growth, but London and East Anglia are barely growing at all. Nationwide's chief economist suggested that seasonal factors may be distorting the picture a little. Still, the fundamentals point to a market in transition. Sellers are adjusting expectations and price cuts are drawing buyers back in. If the Bank of England cuts interest rates over the coming weeks and months, that's looking more likely. We could see stronger momentum throughout the summer. Over to the US now, where markets have rallied hard. The S&P 500 and Nasdaq just closed out their best quarter in over a year, both hitting new all-time highs. So what's driving this bounce? Well, two things. Trade optimism and rate cuts. There's been progress, or at least signals of progress, in trade talks with China, the UK, and Canada. And at the same time, investors are increasingly believing that the Federal Reserve could ease interest rates before the end of the year. That is a big boost in confidence, especially in tech and growth stocks. And with the quarter end ending, there's likely been some so-called window dressing, where fund managers reshuffle portfolios to show they hold the best performing names. But there's risks ahead. Donald Trump's proposed tariffs could take effect as early as the 9th of July. His new tax and spend proposal, a $3.3 trillion package, has also rattled some analysts. Senate Republicans are rushing to get it through before the Independence Day recess. There's also the issue of stretched valuations now. The S&P 500's forward price-to-earnings ratio is now above 22, well above the long-term average of 15.8. Now that doesn't automatically mean a crash is right around the corner, but it does suggest that the market is betting on softer inflation and easier policy to justify the current prices. One fund manager summed it up quite neatly, saying the next few weeks test just how strong these instincts really are. With key data coming from payrolls to earnings and manufacturing data, there's plenty that could shake the sentiment. Finally, let's turn to UK manufacturing. The sector is still in contraction. June's PMI came in at 47.7, which is below the 50 mark that signals growth. But it's the best reading in 5 months, up from 46.4% in May. Output, new orders, and employment all fell, but less sharply than before. Confidence is also ticking up, reaching a 4-month high. This is the 8th straight month of falling production. Many firms are holding back due to weak demand, policy uncertainty, and broader geopolitical pressures. Tariffs and supply chain issues also continue to drag on this activity. And job cuts continued too, this time not just among smaller firms. Actually, larger firms were the hardest hit, and the pain spread across different product areas. But despite this, nearly half of manufacturers, 46%, expect output to rise by the end of the year ahead. That optimism is pinned to expectations of a demand for recovery, new market entries, and product launches. Rob Dobson from the S&P Global gave it a balanced take. He said conditions are stabilising, but the outlook is very fragile. Optimism is there, but it's cautious. With worries about global demand, supply chains, tariffs, and policy direction still hanging over the sector. Well, there's plenty of moving parts this week. The freeze on income tax thresholds is quietly becoming a longer-term feature, and more people are being dragged into higher tax bands without much debate. Labour's silence suggests that it's unlikely to change all too soon. UK house prices dipped again, but behind the headlines we're seeing some encouraging signs. Mortgage approvals are rising, rates could be softening, and buyer activity may build throughout the summer, especially if we get that rate cut. Across the Atlantic, US markets are flying. Investors are pricing in rate cuts and progress on trade, but valuations are getting high. And UK manufacturing. While still under pressure, it's starting to show some resilience. It's not a turnaround yet, but confidence is building slowly. A common theme for this week's briefing. That's all for today's update. Thank you very much for listening.